In this segment, we will look at the identification and measurement of cost behavior. When we are applying cost volume profit analysis, we're rearranging all of the company's costs. Instead of by the product or period type of cost, we're identifying as either variable or fixed. When we are presented with a cost that is mixed, the fixed and variable components must be separated in order to classify all costs as variable and fixed. One such method to break out the variable and mixed elements of a mixed cost is to use a scatter diagram. In a scatter diagram, a series of data points or a series of, let's say, months worth of utility costs are plotted into a diagram. Each of these data points represents a cost in dollars of an electricity cost when a certain number of units are produced. So over the past 12 months, these were the electricity costs that were incurred when units were produced. A line is best fit through all of these data points, and then we take that line and create a linear equation. And that linear equation breaks out the variable portion of the cost and the fixed portion of the cost. The scatter diagram is a very rudimentary way of breaking out cost into variable and fixed. Not very accurate. So another method can be used called the HighLow Method. That HighLow Method takes all those same electricity data points, in other words, all of the electricity cost over a period of time, and the number of units produced over a period of time. For each month's electricity cost, we go in and pick the cost with the higher dollars amount and the month with the lowest dollar amount. We also take the number of units produced or the level of activity when the high data point and the low data point are incurred. And we take the change in the units produced and the change in the cost and use those two data points to calculate a new linear equation. Step one is to compute the variable cost per unit. So we're going to take the change in the dollars and divide by the change in the units to get a per cost variable unit cost. Thus, if we take a linear equation where a company's fixed cost equal the total cost of electricity minus the variable cost, we know that the total cost for one of the data points was $29,000. The total variable cost is going to be the per unit variable cost times the number of units produced at that cost. In doing so, we can take the total cost, subtract out the variable portion of the cost to figure out how much of the cost is fixed. Thus, we know for any month that a company's electricity is going to be variable 17 cents per unit, plus an additional $17,525 in fixed cost. Although we know that the HighLow method is a little bit more accurate than the scatter diagram, today we now have a third method called the least squares regression method. Least squares regression is usually covered in advanced cost accounting courses. Let's just suffice to say that it can be done with spreadsheet programs or calculators today. The objective of using the least squares regression is the same: to put in a series of data points, and the software using statistical analysis determines the total fixed cost and the total variable cost for that cost using that statistical analysis, creating a linear equation similar to the HighLow method and the scatter diagram. However, least squares regression is the most accurate of all because it is able to statistically analyze how accurate the linear equation is to predicting the variable and fixed portions of a cost.